I would say there have not been any major surprises this year. We came into this year, if you think back to what our comments were at the beginning of the year, what we thought was that this market would be much more subdued this year than it was last year, because last year you had a market that was up 5 times as much approximately as corporate earnings. That's not a sustainable movement in markets, because normally over reasonable periods of time you'll get earnings, dividends, and stock prices moving about the same amount, and you can have shorter term variations. This can happen in any one year where you can get earnings go up, dividends go up, stock prices go down, like 2008, or you can get a year like last year, earnings go up 6 or 7%, dividends go up more than that, and stock prices go up 5 times as much as that. We thought that would not be repeated this year. We thought earnings would be up modestly, we thought dividends would continue to grow nicely, but we thought the market would be much more subdued, kind of single-digit sorts of returns, and where dividends played an important role. And I would say so far, through almost 9 months, that pretty much appears to be the case. What you're seeing, I think the surprise is that the market is actually holding up better than one would have thought, given the geopolitical things that have arisen this year, which I think have come pretty much as a surprise. So the market is kind of shrugging these world events, shrugging off these world events, and responding mainly to a situation where corporates are flush with cash, where they have the ability to raise dividends, where you're getting some merger and acquisition activity, where you're getting some companies breaking up and to realize shareholder value. You're getting a lot of activists involved in bringing values to the surface in companies. So it's all in all, I would say, no major surprises in terms of where we are. Maybe a few little squiggles along the way that are different from what you can never actually predict in advance. But overall, decent year. I think people are still nervous generally about the market. There's no euphoria, which is a good thing. Now the market likes to climb a wall of worry. The very low interest rate policy is still in effect. A lot of people came into the year thinking rates would go up sharply. We were not among those people who thought that. We have been much more cautious on the economy than other commentators. Our view being that the consumer-led economy of the prior decade was not going to repeat itself. Individuals are still struggling with lack of income gains and with lack of meaningful job growth. And so what you have is an economy that is fairly subdued. The Fed's comments continue to be benign. I think the Fed agrees with us that this economy still needs support. And so the ultra-low interest rate policy definitely provides a valuation backdrop for stocks. A year and a half ago, in the spring of 2013, we labeled this the golden age of dividends. Dividends had fallen out of favor in the 1990s after being a major component of stock market returns, somewhere between 40 and 50% of stock market returns for the prior 100 years. Dividends fell to where they were 25% of after-tax profits, as opposed to the prior norm of about 50% of after-tax profits. Dividends started becoming important in the last decade. Shareholders who are not getting income from their traditional sources, such as bonds or treasuries, where rates are low, are demanding more in terms of dividends from companies. Companies have the wherewithal in terms of major cash on the balance sheet, and they have the will, because directors, I think, are much more focused on dividends. We think dividends are a great way for people to increase their income. I don't know of any other area of the economy where people are getting the kind of raises they can get from dividends. My outlook is basically this market isn't consistent with our thinking. The underpinnings remain strong enough to keep this market from going into a bear market here. You have valuations that are fair, not stretched, not cheap, but you still have about 30% of the stocks in the S&P 500 yielding more in dividends than the 10-year Treasury. We haven't had that situation since the 1950s. So you still have pretty supportive valuations in many different directions. So the price-earnings ratios are about where they could be. Could they go higher? Yes, in an era of 2.5% 10-year Treasuries. Could they go lower? I mean, last year they went up because people decided that they needed stocks, and it's a measure. It's a matter of supply and demand. But right now the market is not overpriced, not underpriced. Hard to imagine a big bear market starting here with people still nervous, no euphoria, interest rates low. In terms of the market taking off on the upside from here, it's hard to predict. I mean, I have to say stocks, there's still plenty of value being unlocked in stocks. And so probably more of the same, a market kind of chugging along. The only problem that I see with this market right now is it's become increasingly selective, narrower as it goes up. That is to say, the number of stocks participating in the advance seems to be narrowing. On the other hand, the good side is you've had many groups that were strong that have had corrections. Some industrial stocks, some energy stocks have had pretty good corrections, internal. So the market is internally correcting itself without creating a big bear market or a big overall drop. And so you have a market that's on fairly stable footing, I would say.